Welcome to Money Mavericks and Mayhem, the podcast where finance meets audacity in a whirlwind of insight and excitement. Join hosts Adri Bleier and Ryan Duchak as they bring you closer to the stories of risk takers, rule breakers, and boundary pushers who are reshaping the financial landscape. Perfect for seasoned investors, budding entrepreneurs, or anyone curious about the tumultuous world of money. This is Money Mavericks and Mayhem.
And Mayhem, the podcast where we deep dive into the stories that define and redefine the financial world. I'm Ryan Duchak.
And I'm Adri Bleier. Today, we're exploring the groundbreaking work of Harry Markowitz and his seminal contributions to modern portfolio theory, the critical role of diversification in investment strategies, and a technological blunder that cost Knight Capital $440 million. So, whoops. Lots of whoops in these episodes. All right, let's jump into it. All right, today's episode shines a spotlight on Harry Markowitz, a figure whose influence on finance and investment cannot be overstated. Ryan, diving into Markowitz's journey, what can you tell us about his early life and path that led him to develop the modern portfolio theory?
Well, Adri, Harry Markowitz's story begins in Chicago, where he was born in 1927. His academic prowess led him to the University of Chicago, where he pursued studies in economics. It was there, while working on his dissertation, that Markowitz began to formulate the ideas that would revolutionize investment strategy. Rather than focusing solely on maximizing returns, Markowitz proposed evaluating investments based on their expected return and risk, introducing the concept of portfolio diversification to reduce risk. This was a radical departure from existing theories, emphasizing the relationship between risk and return in an investment portfolio.
All right, so obviously, as always, groundbreaking concepts like this must have faced some kind of resistance at the time. How was Markowitz's theory initially received by the academic and financial communities alike?
That Harry didn't know what he was talking about, as usual.
Right. That's typically it.
His ideas, they were met with skepticism. The financial community of the 1950s was, I'll say, heavily influenced by traditional investment strategies that prioritize stock picking based on individual security analysis, whereas Markowitz's quantitative approach, which used mathematics and statistics to model portfolio risk and return, really challenged the norms of the time. However, as a practical application of his theory became more apparent, especially with the advent of computing technology that could handle complex calculations, his work really gained recognition and acceptance, culminating in him being awarded the Nobel Prize in Economic Sciences in 1990.
I mean, that's a big deal, right? I mean, the Nobel Prize.
I think so.
Yeah, definitely no small feat. So, all right. So beyond the accolades, how did Markowitz's modern portfolio theory change the way that we invest or we approach investing?
Markowitz's theory fundamentally changed investment strategy by introducing the concept of diversification as a quantitative method to managing portfolio risk. Before Markowitz, diversification was understood more as a qualitative, almost intuitive practice. But Markowitz showed that by combining assets with varying risk and return profiles, investors could construct portfolios that maximize returns for a given level of risk, or conversely, minimize risk for a given level of return. This led to widespread adoption of diversified investment vehicles like mutual funds and later on exchange traded funds, which I think transformed is the only way to say it, but it transformed the investment landscape.
Yeah, it certainly did. I mean, we certainly use those strategies today. So the implications of his work are obviously vast, spanning individual investors to giant institutional portfolios. So, Ryan, in your research, did you find any particular challenges Markowitz faced in applying his theories in real world settings?
Oh, absolutely. One of the one of his initial challenges was the practical application of his theory, particularly the uh, computational complexity involved in calculating the risk and return of a diversified portfolio. It's easy now, but in the early days, it required extensive data and computing power that just wasn't readily available back then. Now, as technology advanced, the hurdles were overcome, which allowed for broader implementation of his models. Another challenge was convincing investors and fund managers to adopt a more systematic quantitative approach to portfolio construction, moving away from the traditional stock picking methods that dominated the market of the time. Now, over time, as the benefits of diversified investment strategies became evident through improved portfolio performance during various market conditions, Markowitz's theory, that's when it really gained traction.
Which makes sense. I mean, you were talking about technology, and today we take it for granted that you do your research, you have it all at your fingertips. I mean, what was he doing with a pen and paper and like I probably past quill pens, but writing, jotting down every possible metric, and then I can't imagine the hours, days, weeks, months spent on building a portfolio. It would be it just, what we come rely on with technology certainly has helped us, and it's fascinating to really think and see how innovation uh, paired with perseverance like that, just the dedication and the time spent can shift an entire industry.
Mm-hmm.
So, reflecting on his legacy, what do you think is the most important aspect of his contribution to modern finance?
I would say Markowitz's most enduring contribution it's the democratization of investment knowledge. By providing a mathematical foundation for diversification, he made it really possible for anyone with access to market data and computational tools to apply sophisticated portfolio management techniques. So, to your point, with technology improving, it has made it more readily available. Back then, you still needed access to the data and a computer, let alone one powerful enough. But nowadays, it's a lot easier to do. So this not only leveled the playing field for individual investors, but also led to the creation of new financial products and services designed with a goal to optimize portfolio performance. Now, Markowitz's work has empowered generations of investors to make informed decisions, which fundamentally changed our relationship with risk and investment.
Yeah, obviously, the Harry Markowitz journey from a curious student to a Nobel laureate who reshaped finance is, I mean, a testament, I guess, to the power of innovative thinking. His legacy obviously continues to influence investment strategies today and financial technologies worldwide. I mean, it's really incredible when somebody like that pops up and just changes everything.
Yeah, I would say the innovative thinking and the conviction in his theory.
Yeah.
He believed in it, and everyone was skeptical, and he didn't just say, "Oh, okay, I'm wrong."
Right. He did the work, proved them wrong, which is not common.
No, not at all.
All right. Well, thank you for that. When we come back, we're going to talk about the importance of diversification, which is pretty darn important. So we'll be right back with you.
Moving from the theoretical underpinnings laid out by Harry Markowitz to practical advice for our listeners, let's get into the importance of diversification in investment portfolios. We talk about diversification all the time. Pretty much every show, there either transparency or diversification is mentioned. So, Adri,
that's right.
Yes, definitely. Can you jump into this topic and start by explaining the basic premise of diversification and why it is considered essential for investors today?
Of course. Yes, Ryan, I can. So at its core, diversification is all about spreading your investment across various assets, right? To reduce risk of significant losses. The rationale is it's pretty straightforward. I think the different assets and markets react differently to similar or the same economic events, right? So you have defensive type of things or aggressive, and offensive. So they're going to react differently. So by diversifying, an investor can seek to protect their portfolio against significant fluctuations. It's not all fluctuations, right? But generally speaking, significant fluctuations, because while some investments may underperform in that specific time and space, others may excel, which will help balance that overall performance, if that makes sense. As we were talking about Markowitz, his genius was in quantifying this concept and showing that diversification not only reduces risks, but can also lead to improved returns over the long term, right? By optimizing the risk return trade-off. And I want to kind of, emphasize that long term, because I know that there are some investors that like to torture themselves and like to look at their investments every single day, and they internalize that, and it's very emotional for some folks. And a lot of investing, depending on what your goals are, is more designed for more of a long-term road.
Yeah, and the balance between risk and return is shown to be crucial. So how can individual investors implement diversification into their investment strategies?
It can be done, certainly several ways, through asset allocation, as I was talking about, by mixing different types of investments like stocks and bonds, perhaps maybe real estate, for example. Each asset class has its own risk and return characteristics, right? So they don't move in tandem typically. Secondly, within asset classes, investors can even diversify further by investing in various sectors, in various industries, and maybe different geographical regions, for example. Technology, for example, again, has different risk factors compared to, let's say, consumer goods or utilities, for that matter. If you think globally, markets in the US, in Europe, and emerging economies will react differently to global economic events, right? So modern tools like mutual funds that we talk about, ETFs, maybe robo-advisors, have made it easier for investors to achieve a more diversified portfolio, even if you have limited capital, right? So a lot of people think, just making it up, I have $500. What could I invest in possibly for $500? Maybe I could buy one share of, I don't know, it's under $500, Disney. I'm not sure where they are today, but it doesn't matter.
Mhm.
I could buy one share. Well, or you might be able to buy a share of an ETF, like it doesn't really matter, something that's more diversified than just owning one share. Maybe you could buy an ETF that's tracking the S&P 500, for example. So you're kind of invested in those 500 companies instead of just one, just as an example.
Yeah. Yeah, the global perspective is particularly interesting. With the world more interconnected than ever, how do geopolitical events and global market trends affect the strategy behind diversification?
Well, that's good. So the global
A little bit loaded for you, but get after it.
I mean, because it's really both. It has simplified it in some ways, and then in other ways has kind of complicated diversification, right? Because on one hand, a typical investor, any investor, you have access to a wide array of markets and assets, right? From international stocks, maybe commodities, whatever you're looking for, you have access to, which is allowed for broader diversification, as we were talking about. But on the flip side, global events like trade wars or pandemics, we all remember that, political instability, for example, those all can have a very widespread effect, impacting multiple markets simultaneously. So this global dynamic, it makes it complicated, and it just shows you the importance of staying informed, right? Doing your due diligence and possibly incorporating assets that have historically been less correlated with global markets, like certain types of real estate, for example, or alternative investments into a portfolio for even additional diversification from a global scale. Does that make sense what I'm saying?
Yeah, it does. So that brings me to another question, though. Considering,
Fantastic. Thanks.
this is going to be a fun one too. Thinking about the risks and the unpredictable nature of markets, especially with that global interconnectedness, how does one measure if their portfolio is, well, diversified enough or perhaps even too diversified, if that's possible?
What seriously, man? Did I make you angry
You did
today?
it to me last week, I think.
I did do it to you. You're just getting back at me. It is a good question. I mean, it is an interesting question. So let's think. So we're talking about measuring diversification, which
Mhm.
involves assessing correlation between the assets in a portfolio, right? So, and how similarly they react to market changes. It's a tough one. So, a well-diversified portfolio will have assets with low or even negative correlations, meaning they move independently or in opposite directions of each other, right? So, but there is such a thing as over diversification, where when you add more assets, it doesn't really significantly reduce risk further, but can only just starts to dilute potential returns, right? You own so little of everything that it becomes irrelevant.
You're spread too thin almost.
Thank you. Very well put. So today it's much easier because we have tools and software that can analyze a portfolio composition and also correlations that can help investors assess their diversification level. It's also where financial advisors can provide valuable guidance for investors, ensuring that the diversification aligns with the individual investor's risk tolerance and their their investment horizon, for example, what their goals, what their hopes, what their dreams are. Are you looking to leave a legacy behind me? There's so many questions, and everybody's so different. Everybody's situation is so different. But that's where financial advisors can come in and help one place and just look at things and say, hey, you know, diversification is good, but you're spread way too thin, and that's why you're not really seeing much results. Right?
Yeah. I mean, the balance between under and over diversification is pretty delicate. So with evolving markets, new investment vehicle emerging, new technology, how should investors approach diversification moving forward?
Well, investors should always keep in mind that diversification isn't a set it and forget it type of thing, right? It's not a one-time process. It's something that we're going to look at ongoing, and look to rebalance portfolios as some asset classes might go up in value and some go down. Well, we might need to rebalance this because now we have too much in maybe one asset class where we don't have enough exposure in another asset class because of different economic, financial, global conditions that have happened. And you can get carried away and say, oh, look how good this is doing. But you forget that there's always a risk. And while this did really well in one instance, if that instance turns around, this one might do poorly, and the alternative might happen for the asset class that is currently down, if that makes sense. So my point is, you want to regularly review the portfolio and adjust in response to those changing market conditions or life stages, or if your financial goals change, right? That happens. If you've been investing for a while and now you're getting closer to retirement, the likely scenario is that your investment goals are going to change a little bit from more of an accumulation standpoint to maybe something that you're going to want to start bringing in income from these investments. Just as an example, there's lots of reasons that things change. So an investor you want to stay educated on new investment opportunities. You want to stay educated on market trends, but also be wary of chasing that latest fad. I mean, we talk about it all the time without considering how it fits into the broader portfolio strategy that's in place for you, right? And that, I think, is crucial, because we hear about, recently in the last decade, it's been a lot of crypto talk, but which is fine. Invest in what you feel is good for you, but that doesn't mean that if you're a more conservative investor that, crypto is doing really well, let's put that into the portfolio. Maybe it works, maybe it doesn't, but be more mindful, I suppose, about what you're trying to achieve with your money. Ultimately, embracing the diversification is really about accepting that not every investment will be a star performer. Mm-hmm. But we're looking at the collective holistic portfolio. So you want to kind of pursue a balanced, resilient portfolio, capable of weathering different market conditions and volatility over time.
Yeah, I think your insights into the importance of diversification, how to achieve it, and its role in modern investing have been incredibly enlightening. And I also think it's clear that Markowitz's principles remain as relevant today as ever, guiding investors in navigating the ever-growing complexities of financial markets.
For sure. Yeah. I mean, the principles of diversification not only help in risk management, but also really help empower investors to pursue their own financial objectives with greater confidence, I think. So it's a testament to Harry Markowitz, his legacy in the investment world. I mean, it's very uncommon that somebody comes along like that. So to our listeners, keep in mind, there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. We're not saying that. It doesn't protect against market risks. It just helps spread that risk out.
Yeah,
All
that
right,
makes sense.
perfect. Well, stay with us for the next segment where we're going to dive into, or Ryan's going to dive into, the Knight Capital trading disaster.
It's a fun one. Well,
Yeah,
depends on which side you were on.
for sure. We'll be right back. All right, we're back. Let's pivot to a moment that shook Wall Street and served as a cautionary tale about the risks of relying heavily on automated trading systems. Does this seem to be a recurring? I think it's, I don't know. Anyway, so Ryan, the Knight Capital trading disaster is infamous for its immediate financial impact and its lasting implications on the financial industry. So could you start by setting the stage for what happened on that fateful day?
I certainly can, Adri. So that fateful day was August 1st of 2012. Knight Capital, a leading American financial services firm, which was known for its market making and algorithmic trading, deployed new trading software to the New York Stock Exchange. Unfortunately, due to a software glitch, the system started executing unintended trades at a very rapid pace. Within 45 minutes, I will say this again, 45 minutes, Knight Capital accumulated a staggering $440 million loss. They were $5 million, $10 million short of losing $10 million a minute.
That's crazy.
Yeah.
I mean, can you imagine just the people, the panic? I mean,
in 45 minutes. That's a lunch.
Yeah.
You went and had lunch and lost $440 million. Oops.
Yeah.
Yeah, it essentially wiped out all of the firm's capital and threatened its survival. So this event, it not only highlighted the potential dangers of automated trading systems, but also raised questions about the safeguards in place to prevent similar disasters.
Seriously, I mean, I can't even imagine a $440 million loss in less than an hour. You can't really get your head wrapped around it.
No.
It's, so, okay. Well, easy question. What were the immediate consequences for Knight Capital following this disaster?
I believe the immediate consequences were a few choice words that were probably shouted in the Knight Capital offices.
I'm sure.
The financial loss, it severely jeopardized Knight Capital's liquidity and solvency, which prompted basically a frantic effort to secure emergency funding. So within days, a consortium of investors had to step in to basically bail them out with a $400 million capital infusion to save the firm from collapse. Now, that sounds great. They only lost $40 million after this capital infusion, but that came at a pretty steep cost. Existing shareholders saw their stakes significantly diluted with this infusion of capital, and the firm's reputation, I think, substantially declined is a understatement.
Right. I would expect that. I mean, who's going? When you said that they came in and gave him $400 million, it's like I can't even think of.
I'll tell you why.
Okay.
It just wait, there's more. It so what ended up happening is because of the hit to the reputation and the cost. Um, Knight Capital eventually merged with Getco, which was another trading firm, and they formed KCG Holdings, which was an effort to stabilize and salvage the business. So, in today's world of 24-hour news cycles, Knight Capital is no longer a bad firm to work with. KCG is a phenomenal company that should be well respected and trusted because they would never do something so crazy.
I mean, it's kind of the same. I mean, it's the same story over and over, but you have this rapid escalation from a leading market maker to the brink of collapse in mere minutes, right? I mean, I guess ultimately you're talking days, but I mean, just this one because of technology, right? So to me, it just tells that tale about the risks inherent in financial technology, especially when it's new, right? Because we know there's always bugs. It doesn't matter if you have a Mac or a PC, new software, there's an update and there's a bug. There's always bugs. So that becomes scary. So, okay. So in the aftermath of the Knight Capital disaster, how did the industry as a whole and regulators respond then to address these risks and help, try to squash these kind of things moving forward?
Yeah, this one wasn't fraud. It wasn't ill intentions necessarily. Personally, I feel it was um I don't want to say sheer stupidity, but jumping the gun. It the incident served as a wake up call for the industry and regulators to have a closer examination of automated trading systems and the implementation of stricter controls and testing requirements for algorithmic trading. And that's why I say sheer stupidity. This was their money. I mean, they're a market maker, so that there is that aspect to it. But they only harmed themselves in this specific situation. What I can't wrap my head around is how do you roll something out without testing it and testing it and testing it to do everything possible to eliminate the risk of losing $440 million in under an hour. They should have done that. I can't say why they didn't. I'm sure they tested it, but in my opinion, they rolled it out too soon before it was fully tested. And I mean, what we do with our individual clients' portfolios, you put something together, we throw as many rocks as we can at it, trying to break it.
Yep.
And we keep throwing until finally it's as safeguarded as possible from breaking. So why didn't they do that? And why did the regulators, particularly the Securities and Exchange Commission, had to propose new rules to enhance the stability and resilience of the market infrastructure, all because they did not adequately test this. I'm not sure how long they tested for and what number of tests they ran, but clearly it was not adequate. So now the SEC changed a lot of the regulations to include measures like the market access rule, which requires firms to have risk controls in place to prevent the entry of erroneous orders as a result of automated trading. In addition, there's been a greater push for transparency and accountability in algorithmic trading practices to ensure that similar disasters are avoided in the future. I'm sure there still will be some other disaster coming out similar to this, but they at least are attempting to avoid it.
Well, that's good. I mean, it's kind of sometimes all you can do. Transparency, obviously, that's key. So now with this increasing, I mean, it's a reliance, right? We rely on technology, and we rely on technology in trading. So with the lessons from Knight Capital and this disaster that ensued, they seem to be more relevant than ever, right? As we move down this technological wormhole, whatever we're doing. So, Ryan, reflecting on this event, what broader lessons do you think we can draw about technology's role in financial markets?
Well, Adri, the Knight Capital disaster underscores several critical lessons. Initially, it highlights the double-edged sword of technology in finance. It can offer efficiency and new opportunities, but it also introduces new forms of risk. It emphasizes the importance of rigorous testing and validation of trading algorithms and systems before deploying it. Moreover, the incident illustrates the need for robust risk management frameworks that can quickly identify and mitigate unintended trading activity. I think finally it serves as another reminder that in the fast-paced world of finance, technological innovation has to be balanced with caution and oversight to protect the integrity of the markets and the interest of investors. I mean, this isn't going to stop, especially with the invention or addition of artificial intelligence, and how can we work that into trading platforms and trading systems. It all sounds wonderful on paper until it's implemented and not fully tested to make sure it's accurate. So just making sure we do that. I was reading an article a couple weeks ago about the city of New York rolled out a AI feature for small business owners to navigate the layers of bureaucracy to running a business in New York City. And they rolled it out. The AI was spitting out incorrect information to business owners live on the New York City's website. And they had a disclaimer that the information that the New York City's bureaucratic website for small businesses should not be considered legal advice and taken as accurate. What was all they put on there, but that's it. I know it's not finance related, but yet another example of needing to ensure that this is accurate in performing to the measures that it's intended to before you roll it out.
Yeah, that would be. Why don't you ask us some questions before you put it on the website?
Yeah, it's amazing too. I'm not going to try and spit out some of the incorrect information, but there was something like the reporter that wrote the article posed some questions. One of them that I do recall was about serving food. And they asked, like, if a rat was in my restaurant and ate some cheese, is it okay to still serve it? And the answer was yes.
Oh no.
That the AI spit out, that yes, it's still okay to serve that cheese. And again,
the part that the rat ate, and it's good to go.
Basically, and it was like, oh my God, this is crazy that this is live. It was rolled out. It wasn't in a beta form or any testing stage. It was live, and they kept it up. As far as I know, it's still up right now.
That's incredible.
Yeah.
It's scary. I mean, yeah, you're just relying on information that you're getting from AI today. I mean, it's very helpful, but you do want to kind of double check things.
Yeah, and it's just the same thing, bringing it back to the finance world and implementing it on the stock exchange and things like that. You have to test it because the consequences are far reaching. It's not this situation with Knight Capital. If you look at it in a pure vacuum, it only truly impacted Knight Capital and its investors. Or let me restate that. I could argue, well, Knight Capital was the only one hurt. Well, what about all the investors that lost a lot of their share value because of the delusion when they infused that 400 million into it? So through no fault of the investors, and I can also argue that's the cost of doing business in investing. Sometimes this happens, but that should not happen. Things like that should not be rolled out until it's ready.
And it comes down to transparency for investors, because did they know that the Knight Capital was doing this? I don't know. But if they didn't, and they're invested in Knight Capital and they're doing this, you might say, hey, okay, we have all the transparency. I'm not sure that this is ready for the markets. Maybe I should back out of some position in Knight Capital and see where this thing is going to go. Or at least if I have transparency, I say, okay, I'll take that risk with them. At least I can make a decision. But if I don't know, and I'm not saying that investors didn't know, because I don't know whether they did or not, but that's where transparency comes in, so that an investor can make their own decision on any situation that's moving forward.
Yeah,
it's one of the tough things with Apple, because Apple is always very, very quiet about what's happening. I mean, their track record's very good, but as an investor, you don't know where Apple's going.
No. It's a fine line, though, too, to pick on Apple, or not even pick on necessarily, if Apple all of a sudden opened the doors and the windows and full transparency, they are trying to develop so many different things.
Sure.
If they start giving full access to everything they're working on, that can be an overload of information. So a lot of times when there's too much information about something, you don't know what's important and what's not.
Yep.
So finding, and this is one of the responsibilities of a public firm, finding that balance of giving the transparency without overwhelming individuals or the people interested in your company with too much information, that it ends up basically becoming like if Knight Capital laid out every single trade they were doing, everything they were working on, it becomes a needle in the haystack to find that they're releasing this technology next week. So it's the role and responsibility, in my opinion, and I know yours as well, of that leadership to find that balance and be transparent on the things that could significantly impact investors.
Yeah, absolutely. Well, thank you, Ryan. I think those are all really good points. I think today's episode, talking about that pioneering work of Harry Markowitz through the definitely critical strategy of diversification, to the technological cautionary tale, perhaps, of the Knight Capital disaster. It's been a good talk through the evolution of financial thought and ongoing challenges of integrating technology into this financial world.
Absolutely, Adri. These stories not only illuminate key principles and moments in financial history, but also remind us of the continuous need for innovation, vigilance, adaptability in navigating the complexities of the markets. So thank you, Adri, for your insights, and to our listeners for joining us on Money Mavericks and Mayhem.
And thank you, Ryan. So we look forward to bringing you guys, our audience, more stories of innovation, of strategies, and lessons learned from the ever-changing world of finance. So we appreciate you listening, and we'll talk to you next time on Money Mavericks and Mayhem.
Take care.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks including possible loss of principal. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC.